into killer prediction video. Let's see what happens. Ready, go.
To the show, interest rates are down, housing sales are up, unemployment is up, the Dow is down. Are you confused about all the ups and downs in the economy and what it all means to you? My guest today has some answers and some predictions of what may happen here in the near future. Peter Schiff is a stockbroker and analyst and is president of the brokerage firm Euro Pacific Capital. Thanks for joining us.
Thanks for having me.
This morning. You know, there's been a lot of confusion. I think we were all happy for a while. Tech stocks were doing really well. Housing prices are up. Interest rates are down. September 11th came along, and we've had kind of nothing but bad news ever since. Is this expected? Is this what's going to happen? What's going on?
Well, I think the news is going to get a lot worse. I mean, first of all, when you said that tech stocks were doing well, the stocks were doing well, but the companies were never doing well. A lot of the earnings were being manufactured. A lot of the executives of the tech companies are compensated through stock options, and therefore their incentive is to do whatever they can to get the short-term price of the stock up so that they can sell their options and make money. It doesn't matter if what they're doing is sacrificing the long-term solvency of the company. They don't care about the long-term solvency because they're selling in the short run. So rising prices only benefit you if you're going to be a seller. But as a long-term investor, you've got to look at the fundamentals of the company. You've got to look at the dividend yields. That's how you make your return. I mean, what a stock is, the way you value a stock, it's the present value of its future dividend streams. And most people today who are buying stocks don't even look at dividends. And most companies aren't paying them, which is one of the reasons that they can get away with faking their earnings. Because if you don't have to pay a dividend, you can pretend you're making money. Just like the reason that Enron was able to pretend they had earnings is because they didn't have to write a check. You can't send out a pro forma dividend check that says, this is the money that we could have paid you out in dividends, right. But don't cash it. So the market is still extremely overvalued, and don't believe the propaganda. And that's what it is. When you're listening to an analyst on a lot of these popular financial shows, or the mainstream Wall Street firms, you're not getting investment advice. You're getting propaganda. These firms are trying to sell you stocks. Their real clients, their banking clients, are trying to get rid of stock. And they hire these Wall Street firms to peddle their merchandise, and they want to get as much as they can for these overvalued stocks. So you're not getting unbiased advice by the media. We are in the early stages of a bear market. This bear market is going to last for a long time. We were in a bull market from 1982 to 2000. Mm-hmm. Bear market began in 2000. It's probably going to last another 5 to 10 years. I think the bulk of the downside is going to happen in the next couple of years. Then we'll probably trade sideways for a while, but inflation will be very substantial. Just like people forget, we had a terrible bear market in the 1970s. Right. The market peaked, the Dow Jones peaked in 1966 at 1,000. It then went down to about 600 in 1974. It didn't get back above 1,000 until 1982. So from 66 to 82, you were at 1,000. Meanwhile, inflation was tremendous during that period. So $1,000 in 1982 was not $1,000 in 1966. It wasn't until 1995 that the Dow got back to 1,000 adjusted for the CPI. And I can tell you this, the market even today is much more overvalued by any valuation metric than the market was in 1966. So you can expect a far more severe bear market. And the U.S. financially is in far worse shape as a nation. Back in early 1970s, we were still the world's largest creditor nation. Now we're the world's largest debtor nation. We had a large current account surplus. Now we have a large current account deficit. Back in the early 70s, I think the average American, the savings rate was still about 10%. Now it's negative. So people are loaded up with debt. People are, their houses are mortgaged to the hilt. We have a huge national debt. We have an enormous current account liability. So we're going to enter this bear market financially on much shakier ground. So as I said, my prediction for the Nasdaq is it's going to fall to around 500. Right now, about 1,700. Got a long way to go down. The Dow Jones still above 10,000. Probably going to fall to between 2,000 and 4,000, but it might go below 2,000.
I've got to ask because, of course,
stop.
You mentioned media, and that's really what...
So, okay. Don't show this one yet. This is too good. Don't show the end. Okay. So I want to make sure that we got the predictions. He said a lot of stuff in there. So Dow going to 2,000. 2,000.
And 2 years of down markets from 2002.
And at least 2 years of terrible markets.
And sideways.
And then sideways for a while.
Of course, always
So
sideways.
terrible markets, then sideways, then more downwards. So it's just going to be doom and then more doom. Right? I want to make sure I got that right.
Yeah.
Everything's overvalued, nothing ever makes any money. As a matter of fact, he seems to make the argument that because we went through a period where U.S. stocks didn't make much money for 15 years, which he was correct about, that really equity should really make any money. U.S. stocks really, from what you're hearing here, should never really make money, and they're way overpriced, and they should never be going up. Am I right so far?
Yeah, that's pretty much exactly what he's saying.
Okay, I want to make sure I got it right. Okay, so maybe we should look at what happened after that. So then the cumulative rate of return for the Dow after his little video that he went on, 1/1/2003 to 12/31/2007, cumulative rate of return for the Dow, 72% at an annualized rate of return of 11.5%. Was not a crash. Not even close to a crash. What about the S&P? S&P goes from 1/1/2003 to 12/31/2007, cumulative 82% for an annualized rate of return of 12.8%. Doesn't sound like a crash to me. Interesting. But nobody calls Mr. Schiff on this. Well, actually, I take that back. There are several articles on the internet who have said he was wrong, and obviously he was wrong. But here's what I'm interested in. I'm interested in the human psychology that allows people to be wrong, but yet to deny that they were dead wrong. So he was dead wrong, but no one wants to admit it. His followers don't want to admit it. Some academically minded people will point it out. But even if you point it out to Peter Schiff, what he'll say is, and we have some video later showing this, well, I wasn't really wrong, the market was wrong. It shouldn't have been that way. This shouldn't have happened. I was really right.
Yeah.
This was wrong.
Yep.
It's delusional.
The market, all those billions of people, those are the ones that are wrong, not me.
They missed
Can't be me.
They missed the demographics.
They missed the demographics.
Reality was wrong.
Reality was wrong.
He
The
lives in
prices
an
are
alternate
wrong.
universe.
It's a conspiracy by the banks and the big brokerage firms to have stocks be inflated when they're really not worth that. And to add insult to injury, NASDAQ, that he said was going to 500, went up 106% for an annualized rate of return of 15.6%. 15.6%. U.S. small value went up 140% for annualized 19.15%. If Mr. Schiff is so clairvoyant and so able to see every nuance of change coming our way, why did he not call out 19% for small U.S. value stocks? Why did he say they were crashing?
He wasn't looking at those.